Welcome friends to Markets and Economics. Markets are known for their dramatic swings, shifting rapidly from exhilarating booms to challenging busts. These cycles can be both thrilling and daunting, often leaving investors wondering what comes next. In this video, we'll break down the key phases that define every market cycle, from periods of rapid growth to sudden downturns. By understanding the unique characteristics of each phase, you'll be better equipped to anticipate changes and make informed decisions. Get ready to explore the patterns behind market movements and discover strategies to navigate every stage with confidence. A market trend refers to the general direction in which the price of an asset or market is moving over a specific period. There are three primary types of trends: uptrends, downtrends, and sideways movements. An uptrend is characterized by consistently higher highs and higher lows, indicating rising prices. Conversely, a downtrend features lower highs and lower lows, signaling falling prices. Sideways movements, or ranging markets, occur when prices fluctuate within a narrow band, showing no clear upward or downward direction. Recognizing the dominant trend is crucial, as it forms the basis for all market analysis and helps traders and investors make informed decisions. Understanding whether the market is trending up, down, or sideways allows for the development of appropriate strategies tailored to current conditions. Market sentiment plays a crucial role in shaping financial trends, often driven by the powerful emotions of fear and greed. When investors are fearful, they may rush to sell assets, causing prices to drop. Conversely, widespread greed can lead to rapid buying and inflated valuations. To better understand and measure these emotional forces, analysts use tools such as the Fear and Greed Index and the VIX, also known as the Volatility Index. The Fear and Greed Index aggregates various market indicators to gauge the prevailing mood, while the VIX tracks expected volatility in the S&P 500, often rising during periods of uncertainty. By quantifying sentiment, these tools help investors make more informed decisions and anticipate potential market shifts. A bull market is characterized by a prolonged period of rising asset prices, often driven by strong investor confidence and positive economic indicators. During these phases, markets typically experience higher highs and higher lows, signaling consistent upward momentum. Optimism prevails, with investors expecting continued growth and profitability. For example, the bull market following the 2008 financial crisis saw the S&P 500 steadily climb for over a decade, marked by frequent record highs and robust corporate earnings. Another notable instance is the technology-driven bull run of the late 1990s, when enthusiasm for internet stocks fueled rapid price increases. Common signals of a bull phase include increased trading volumes, expanding corporate profits, and widespread media coverage highlighting market gains. These features collectively distinguish bull markets from other market cycles. Market corrections are defined as healthy, temporary declines in stock prices, typically ranging from 10 to 20%. These corrections occur when markets become overheated or valuations rise too quickly, prompting a natural pullback. Investors can identify a correction by observing sustained drops in major market indices within this percentage range, often over a period of days or weeks. Corrections serve an important role by resetting market excesses, helping to prevent bubbles and maintain long-term stability. They allow prices to realign with underlying fundamentals, offering opportunities for investors to reassess their positions. While corrections may cause short-term uncertainty, they are a normal and necessary part of the market cycle. The bear market phase is characterized by sustained declines in asset prices, typically falling 20% or more from recent highs. This period often reflects widespread investor pessimism and uncertainty, as negative sentiment takes hold and selling pressure intensifies. Psychological signals include fear, loss of confidence, and a tendency for investors to exit positions, further driving prices downward. Technically, bear markets are identified by lower lows and lower highs on price charts, along with declining trading volumes. Notable examples include the Great Depression of the year 1930s, the dot-com crash in the early 2000s, and the global financial crisis of 2008, each marked by sharp drops in market value and prolonged recovery periods. These historical events underscore how bear markets can reshape investor behavior and influence broader economic conditions. Market crashes are characterized by abrupt and dramatic declines in asset prices, often triggered by widespread panic or acute liquidity shortages. During these events, investors rush to sell holdings, amplifying downward momentum and sometimes causing systemic disruptions. Notable crashes, such as the 1929 Great Depression and the 2008 financial crisis, resulted in significant economic fallout, including prolonged recessions and shifts in regulatory policies. While some crashes lead to rapid recoveries, others have lasting effects on investor confidence and market structure. The outcomes of these events vary, but they consistently influence the broader market cycle by resetting valuations, altering risk perceptions, and prompting changes in monetary and fiscal policy. Ultimately, market crashes serve as pivotal moments that reshape the trajectory of financial markets and the economy as a whole. Consolidation periods occur when asset prices move sideways, remaining within a relatively narrow range for an extended time. During these phases, buyers and sellers reach a temporary equilibrium, causing the price to fluctuate between established support and resistance zones. Support is the lower boundary where buying interest tends to prevent further declines, while resistance is the upper boundary where selling pressure limits upward movement. These zones are shaped by repeated tests of price levels, reflecting market sentiment and supply-demand dynamics. The significance of consolidation lies in its potential to precede major price movements. A breakout above resistance or a breakdown below support often signals a shift in momentum, leading to increased volatility and new trends. Traders closely monitor these events, as they can provide valuable opportunities for entry or exit. Volatility refers to the speed and magnitude of price changes in financial markets. High volatility means prices can swing dramatically in a short period, presenting both risks and opportunities for traders. Rapid price movements can lead to significant gains, but they also increase the potential for substantial losses. To better understand and manage volatility, traders often rely on indicators such as the VIX, which measures market expectations of future volatility, and the average true range, or ATR, which quantifies recent price fluctuations. By analyzing these indicators, traders can gauge market sentiment, adjust their strategies, and make more informed decisions about entry and exit points. Ultimately, understanding volatility is crucial for navigating the dynamic nature of financial markets. Understanding market phases requires a combination of technical indicators and analytical tools. Moving averages help identify the overall direction of price trends, smoothing out short-term fluctuations. The Relative Strength Index, or RSI, signals whether an asset is overbought or oversold, providing insight into potential reversals. Average True Range, or ATR, measures market volatility, while the VIX index offers a broader view of expected volatility in the market. Volume analysis reveals the strength behind price movements, and trend lines visually map support and resistance levels. By combining these tools, traders gain a more comprehensive perspective, reducing reliance on any single indicator and improving the accuracy of their decisions. The market cycle is composed of 4 distinct phases: accumulation, markup, distribution, and markdown. During accumulation, savvy investors quietly buy assets while most remain cautious, often driven by fear or skepticism. As confidence grows, the markup phase begins, characterized by rising prices and increasing public participation, fueled by optimism and even greed. Eventually, the distribution phase sets in, where experienced players start selling to latecomers who are still hopeful. This leads to the markdown phase, marked by falling prices and widespread pessimism or panic. Emotions like fear and greed drive each stage, shaping collective behavior. As the legendary investor Sir John Templeton once said, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria." Remember, markets move in cycles. What goes up must eventually come down. Throughout history, financial markets have experienced distinct phases that often repeat in recognizable patterns. For example, the dot-com bubble of the late 1990s saw rapid growth and exuberance, followed by a sharp correction in the early 2000s. Similarly, the housing market boom leading up to 2008 was characterized by rising prices and widespread optimism, culminating in the global financial crisis. The cryptocurrency market has also exhibited cycles of dramatic expansion and contraction. By examining these historical events and major asset cycles, investors can identify common signals and behaviors associated with each phase. Understanding past market patterns provides valuable context for interpreting current conditions and anticipating potential shifts. In every market phase, having a clear strategy is essential. During bullish periods, consider riding the upward momentum, but remain vigilant for signs of overextension. In bearish markets, focus on capital preservation and look for opportunities to buy quality assets at discounted prices. Sideways or consolidating markets often call for patience, with range-bound trading or waiting for a clear breakout. No matter the phase, risk management is crucial. Set stop losses, diversify your portfolio, and avoid emotional decision-making. By adapting your approach to the current market environment, you can navigate uncertainty more effectively and make informed choices. Throughout this video, we've explored the cyclical nature of financial markets, highlighting how periods of growth and decline are a recurring pattern. One of the key lessons is the importance of maintaining discipline, especially when emotions run high during market fluctuations. By understanding these cycles, investors can make more informed decisions and avoid common pitfalls. Staying patient and sticking to a well-thought-out strategy often proves more effective than reacting impulsively to short-term changes. We encourage you to reflect on where you believe we are in the current market cycle and share your thoughts. Your perspectives can help foster a deeper discussion and collective understanding of the market's ongoing dynamics. So, the market is a story of fear and greed, playing out in predictable phases. By learning to identify bull markets, bear markets, corrections, and consolidation on a chart, you take the first step towards becoming a smarter, less emotional investor. Understanding these market phases is what separates the anxious investors from the confident ones. And that's exactly what we are building here: a community of confident, educated investors. If you're ready to take control of your financial education, then your next steps are simple. Join our crew by hitting that subscribe button. We are building something special here, and I don't want you to miss out. Ring the notification bell so you're always in the loop. Drop a comment and let your voice be here.